Alfonso Cahero, A Journey into Finance History, Chapter 21. Introduction of the Gold Standard in the UK, 1821. Before delving into the introduction of the gold standard in the United Kingdom in 1821, it's essential to understand the historical context of monetary systems. Throughout history, societies have utilized various forms of currency to facilitate trade and commerce, ranging from commodity money, such as shells and livestock, to representative money, such as coins and banknotes. However, as economies evolved and expanded, the need for a standardized and universally accepted medium of exchange became increasingly apparent. In ancient times, currencies were often tied to tangible assets like gold, silver, or other precious metals. These metals were valued for their scarcity, durability, and intrinsic worth, making them ideal mediums of exchange. As societies grew more complex, governments began to issue coins made from these metals, establishing a standardized system of currency that facilitated trade and economic growth. During the Middle Ages, the use of gold and silver coins became widespread across Europe, with monarchs minting their own currency to finance wars, build infrastructure, and fund government expenditures. However, the value of these coins often fluctuated due to factors such as debasement, counterfeiting, and fluctuations in the supply of precious metals. In the early modern period, the emergence of banking institutions and the advent of paper money revolutionized the way economies operated. Instead of relying solely on precious metals, governments and banks began issuing paper notes that were redeemable for specie upon demand. This system, known as the gold standard, provided a more flexible and convenient means of conducting transactions while still maintaining the backing of tangible assets. The decision to introduce the gold standard in the United Kingdom in 1821 was influenced by a myriad of economic, political, and social factors. By the early 19th century, Britain had established itself as a dominant economic and colonial power, with a vast empire and a burgeoning industrial base. However, the country's monetary system was in need of reform, as years of war, inflation, and financial instability had eroded confidence in the existing currency system. One of the primary motivations behind the adoption of the gold standard was the desire to stabilize the currency and restore confidence in the financial system. In the aftermath of the Napoleonic Wars, Britain faced significant economic challenges, including high inflation, currency depreciation, and a shortage of specie. By pegging the value of the pound to a fixed amount of gold, policymakers hoped to curb inflationary pressures, promote fiscal discipline, and reassure investors and creditors of the currency's stability. Additionally, the gold standard was seen as a means of bolstering Britain's position in the global economy. As the leading trading nation of the 19th century, Britain relied heavily on international commerce and finance to fuel its economic growth. By adopting the gold standard, Britain aligned its currency with the prevailing international monetary system, making it more attractive to foreign investors and facilitating trade and investment flows. Politically, the adoption of the gold standard was also driven by considerations of national prestige and influence. As the birthplace of the Industrial Revolution and the epicenter of global trade and finance, Britain sought to assert its dominance on the world stage by adopting a currency system that reflected its economic prowess and stability. By anchoring the pound to gold, Britain signaled to the world its commitment to sound money principles and its willingness to uphold the integrity of its currency. The implementation of the gold standard in the United Kingdom in 1821 was a complex and multifaceted process that involved a series of legislative measures, policy decisions, and institutional reforms. One of the first steps taken by policymakers was to establish a fixed exchange rate between gold and the pound sterling, effectively pegging the value of the currency to a specific weight of gold. This fixed exchange rate was intended to provide stability to the currency and prevent fluctuations in its value relative to gold. To facilitate the transition to the gold standard, the Bank of England, Britain's central bank, played a central role in managing the country's gold reserves and regulating the money supply. The Bank of England was tasked with maintaining the convertibility of the pound into gold at the established exchange rate, ensuring that the currency remained fully backed by tangible assets. In addition to monetary policy measures, the government also enacted legal reforms to support the implementation of the gold standard. Laws were passed to standardize the weight and purity of gold coins, regulate the issuance of paper money, and establish mechanisms for the redemption of banknotes for specie. These legal reforms were designed to instill confidence in the currency and provide a framework for its operation within the gold standard system. However, despite the best efforts of policymakers, the transition to the gold standard was not without its challenges. One of the primary obstacles was the need to maintain a sufficient supply of gold to meet the demands of domestic and international commerce. This required the Bank of England to actively manage its gold reserves, intervene in foreign exchange markets, and adjust interest rates to maintain the stability of the currency. Moreover, the rigidity of the gold standard posed challenges for policymakers in responding to economic fluctuations and crises. Unlike fiat currencies, which can be adjusted in response to changing economic conditions, the value of the pound under the gold standard was fixed, limiting the government's ability to implement monetary stimulus or devalue the currency to boost exports. Despite these challenges, the adoption of the gold standard in the United Kingdom in 1821 was ultimately viewed as a success, laying the foundation for over a century of monetary stability and prosperity. The gold standard became the cornerstone of Britain's economic and financial system, providing a benchmark for currency stability and serving as a model for other nations seeking to establish sound money principles. The introduction of the gold standard in the United Kingdom in 1821 had profound economic implications, shaping the country's monetary policy, trade dynamics, and overall economic performance. One of the key impacts of the gold standard was its role in promoting price stability and curbing inflation. By fixing the value of the pound to a specific quantity of gold, policymakers were able to anchor the currency's value and prevent excessive fluctuations in prices. This stability in prices provided businesses and consumers with a predictable economic environment, encouraging investment, consumption, and long-term planning. Moreover, the gold standard instilled confidence in the financial system, attracting foreign capital and facilitating international trade. With a stable and reliable currency, Britain was able to expand its global trade networks, export goods and services, and establish itself as a leading economic power. However, the gold standard also had its drawbacks, particularly during periods of economic downturn or financial crisis. The fixed exchange rate between gold and the pound limited policymakers' ability to respond to changing economic conditions through monetary policy measures such as interest rate adjustments or currency devaluations. This rigidity could exacerbate economic recessions, deepen deflationary pressures, and prolong periods of unemployment and economic hardship. Additionally, the gold standard contributed to income inequality and social unrest by favoring creditors and investors over debtors and workers. During times of deflation, the real value of debts increased, making it harder for borrowers to repay loans and mortgages. This burden fell disproportionately on lower-income households, leading to social tensions and calls for economic reform. Despite these challenges, the gold standard remained the cornerstone of Britain's monetary system for much of the 19th and early 20th centuries, providing a foundation of stability and predictability in an increasingly interconnected world. The adoption of the gold standard in the United Kingdom had far-reaching international ramifications, influencing the global monetary system and shaping the course of international trade and finance. As the world's leading economic and colonial power, Britain's decision to adopt the gold standard set a precedent that was emulated by other nations seeking to establish stable and credible currencies. One of the key consequences of the gold standard was its role in promoting international trade and investment. By fixing the value of the pound to a specific quantity of gold, Britain provided a reliable benchmark for other countries to peg their currencies against, facilitating exchange rate stability and reducing currency risk. This stability encouraged cross-border trade and investment, as businesses and investors could conduct transactions with confidence, knowing that the value of their currency would remain relatively stable.